So hopefully you've tried S5-21 on your own. If you haven't, please just pause, do it on your own, and then come back. So this question says that Minute Company began the year with inventory of 16,000. During the year, they purchased 180,000 of goods and returned 12,000 due to damage. Minute also paid freight charges of 1,500 on inventory purchases. At year-end, Minute's inventory, based on the physical count, stood at 32,000. They used the periodic inventory system. So we need to compute the cost of goods sold for the year. So we're going to use this breakout that I introduced in the last video and calculate cost of goods sold. Whoops. So we always start with the opening inventory. Which it tells us is $16,000. And we're given purchases and the returns. So we need to calculate our net purchases. So we start with the purchase amount, purchases, which was 180,000. And then we're going to say less the purchase returns and allowances. So I know it just tells us returns, but we would name the account purchase returns and allowances. So that's what we'll say here. That was 12,000. So we're calculating from the purchases minus these purchase returns and allowance. We calculate net purchases, which are 168,000. We then also need to add our freight in because we paid this. It's a cost of inventory. So we add freight in, which was 1,500. So those are all of the costs or all of the amounts that we had available. So when we add that, we get to cost of goods available for sale. And that is 185,500. So remember, we're adding our net purchases and adding freight in here to get to that cost of good available for sale. Then this company did the count. So we are able to subtract or say less our ending inventory, which was counted at 32,000. Therefore, if we had 185,500 available, we're left with 32. We clearly sold the rest. So it would be our cost of goods sold, which is 153,500. So if you were doing the income statement for this company, Minute Company, you would have started with your sales above, and then you get to your cost of goods sold here, and you would subtract that from your sales to get to your gross margin. So we don't have all of that information, so we are not expected to do that, but that's what you would see on the income statement. You see this full calculation there. Okay, so that is really the end of chapter 5. Again, our focus is perpetual. You need to know the entries that are recorded there. And then for periodic, you just need to understand that the inventory is not updated through the year. Instead, we do this calculation at the end of the year once we've done our inventory count, and then the inventory balance would be updated to this 32,000.